The Bangko Sentral ng Pilipinas now warns the 6 to 7% growth target may only be met by 2027. Infrastructure spending has surged from just 1 to 2% of GDP under GMA and Pinoy to 5 to 6% under Duterte and Marcos. But with half of that money reportedly stolen or wasted, the real impact is only 2.5 to 3%, explaining why growth hasn't accelerated despite record borrowing. So are the gains being stolen? To help us make sense of the true state of the economy and what it means for companies, markets, and investors, we're joined by Jonathan Ravelas, Senior Advisor at Reyes Tacandong Company. Good morning, Jonas. Thanks for being here with us.
Good morning, Mikey. Good morning to your listeners.
Yeah, lots to unpack, Jonas. Let's start with the bigger picture. The BSP warns that the 6 to 7% growth target may not be hit until 2027, with slowing growth and corruption scandals clouding sentiment. What would you say is the true state of our economy right now?
Well, we're currently in a holding pattern. I think from 2022 to the 2024, we were mired by the impact of higher inflation. And of course, to a certain extent, looking back, given these corruption issues, that helped contribute why we're not feeling the impact of this growth that we've seen. At the same time, in 2025, the added worry of Trump's tariffs have really kept investors and business on the sideline.
Yeah, domestic issues and an uncertain global climate, it's really clouding the outlook for anybody. A lot of the people have been saying that the growth that we've been feeling, the Philippines has been registering growth of about 6% on average for the past 5 years. But a lot of people are saying that they aren't feeling the gains on the street. How much of this is because of corruption and all the money lost to leakages, Jonas?
Well, basically, I think one of the things that we can probably look into it is that we can look at it from an analogy of a driver starting his car, driving, and without putting down the handbrake. So there's no acceleration. We're just holding to that probably 5 to 6% growth, and we're not feeling it. And one of the main factors is inflation. From 2022, we were really hit by that. And remember, we were still recovering from the pandemic. And then you add the corruption issues. So these factors eventually did not help trickle down to the grassroots in terms of growth.
Yeah. So right now, our economy, we're in a holding pattern. We're just surviving. 70% of the growth in the Philippines is driven by consumer spending. With a government holding back on expenses in light of all of these corruption revelations and allegations, what is your outlook now for growth?
Well, for 2025, I was actually initially looking at 6%, but most likely will grow closer to around 5.7%. Hopefully, with inflation currently at 1.5, I think this below 2% trend could continue till year end. So that should at least see some recovery in consumption between now and year end.
Mm-hmm. Going back to an earlier report from just earlier this morning, the national government's budget deficit widens to 84.8 billion in August. It's a sign that fiscal pressures are building. What are your thoughts on this amount, Jonas?
Well, basically, I guess given the slowdown in the economy and again, slower revenues, the challenge really is that most likely government borrowings will continue to rise. And that means for the local investor and business is that could keep interest rates, particularly on the long term, holding up despite expectations of rate cuts on the short end.
Mm-hmm. Going to infrastructure spending, Jonas, infrastructure spending has climbed from 1 to 2% of GDP in the past to 5 to 6% of GDP. We've got those figures on the screen. Half of it is lost to corruption. So the real impact is really just 2.5 to 3%. In terms of economic performance, why hasn't bigger spending delivered faster growth?
Well, basically, I guess one of the things is that we expected that these infrastructures would attract foreign direct investment, especially with the push of moving into manufacturing under President Marcos. However, that has slowed down, and again, when people see the impact to our infrastructure with this climate-related issues like floods, it's very difficult to look at the Philippines as a manufacturing destination, especially when we still lack infrastructure. Although
Yeah.
it is promising because of our uh, our geography, meaning we're very strategically located within the ASEAN. So this is actually good for us. It's just that with all of these issues of corruption as well as the lack of infrastructure is deterring um, potential investors.
Yeah, not to mention the Philippines was just named as the world's most disaster-prone nation for 20. It's the 21st year in a row. So the location is it's a boon and it's a bane for us. Jonas, according to the DBCC, our infra budget for 2023 to 2028 is around 1.5 to 1.6 trillion pesos. That's it equals our deficit. So all of it has to be borrowed. If half is wasted, are we simply piling up debt without that growth dividend?
Well, basically, we have to continue with this infrastructure spending. Now, the problem really is that if we continue without doing the necessary adjustments in transparency, accountability, and governance, then we're really, we're trying to uh, put burden to our future generations with this debt.
Yeah, we have to be careful with that money because, we don't want to just be borrowing money for thieves. Jonas, tracking the latest debt figures under President Marcos Jr., this is based on the Department of Finance, the DBCC, and the Bureau of Treasury. Our national debt has reached 21.9 trillion. That's up 9.1 trillion pesos from the start of the term of this administration. Our debt to GDP ratio is now at 60.3. That's close to the international red line, which is 70. From your perspective, how should we interpret this debt buildup?
Well, you have to understand that we came from a pandemic and we're slowly getting out of this. And you have to understand that this administration inherited a huge portion of the debt from the pandemic. So it gives them little wiggle room to make the necessary uh, adjustments so that we get to see a lot of activity. So unlike in the Duterte administration when they came in, it was at 39%. So if you were to look at it from a simple uh, credit card debt, we've given you have a 1 million credit line. You've done 390,000 used under Duterte. And right now, it's just 600,000. So you have very little wiggle room to
Yeah.
make a budget. So it's very difficult for government, especially now that things are tied with the DPWH secretary holding local infrastructure. So we need a portion of that for them to spend into the economy.
Yeah. At 60.3, how worried are you, Jonas? Debt to GDP ratio at 60.3.
Well, I think at 60.3, we still have a lot of leeway, even though it's near the 70%. We've been worse, way over 70% during the 1998. So I think we still have some wiggle room to move. Remember that the economy is much stronger now than where we were during the late 1990s.
Yeah, okay. Speaking of the economy, President Marcos ordered the DPWH to slash 252 billion pesos worth of flood control projects flagged for irregularities. That's nearly 30% of the 2026 proposal. From a macro perspective, Jonas, how do these cuts affect our growth?
Well, basically, what is important really when we think about economic growth is the easy translation of this spending that will trickle down to the economy. And infrastructure spending helps create jobs. So this is, I think, what we saw during the former President Duterte's term, that with the build, 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 it actually created a lot or unlocked a lot of those disposable income. given the set of low interest rates and what uh, from where they were standing at that time. Now, fast forward to today, that we're still challenged by high inflation, shifting infrastructure spending to probably like education, health, and probably even agriculture for food security will mean longer gestation period to uh, get the trickle down effect rather than the infrastructure
Yeah,
spending.
it will be a multiplier, but again, a much longer gestation period, as you mentioned. Going back to inflation, Jonas, inflation is at multi-year lows. Headline inflation is below 1%, core just above 2%. How sustainable is this trend? And when you talk about the risks in the second half, there's oil, there's La Nina, there's the global shocks. How big of a concern is this to you?
Probably between now and year end, we'll probably end the year slightly below 2%, probably 1.7%. So this actually gives a lot of room to um, for BSP to still cut possibly rates by another 25 basis points to 475 as early as this October.
Yeah.
And move forward to 2026, I think we can probably say 2-3% would probably be where we see inflation averaging in 2026.
Yeah, with the Fed cutting interest rates, that gives the BSP more room to do so. They meet next on October 9th. You're expecting a 25 bips cut by the end of the year. What about for 2026, Jonas?
Well, initially, I think my baseline is still looking at probably if we end at 475, then probably we're looking at another maybe 50 to 75 basis points. That will depend on how we look at the inflation picture. But if it stays between 2 to 3%, I think we can go back to the 4%, and that I think that will help growth and probably secure that 6% by 2027.
At the same time, Jonas, there are expectations that GDP targets for 2025 through to 2027 could be revised lower. Right now, the PSC index is at about 6,100. We are trading at the steepest discount to our peers in the region since 2009, 16 years. If growth targets, if our GDP is revised lower, how much lower do you think the PSC index will go?
Well, basically, I think the risks are between 5.5 to around 5.8 to probably reflect the slower growth and eventually the doubt. The steep discount is actually the doubt of investors to our capability to sustain growths above 6%. And despite the PEs of the market at 9 times forward PE, relative to our peers of 17 times, it's really showing the non-confidence or the fears that we're seeing, whether it's driven by inflation, driven by concerns over the tariff, or most likely the corruption issues. So, but the global uncertainty is actually one of the biggest that has kept investors sidelined.
Yeah, wow, 5,500 to 5,800. But what would be your year-end target for the PSC index at this current trajectory, Jonas?
I think would be very lucky to probably stay at 6.1.
Wow, ouch. Okay, wow. Okay, let's see. Foreign funds, this macro backdrop. We've got, easy inflation, lower rates, plus the governance risks. How much more difficult is the Philippines to sell at this junction?
Well, basically, I think at this point in time, it's just a matter of pricing. I think we have a compelling issue, and I think this is, I think, one of the very easy way of describing where the Philippines is. The present value of the Philippine stock market is like a fried chicken, probably 350 pesos, one whole chicken, while Peking duck is basically around between 2,500 to 3,000. So that's how heavily depressed the Philippines is. However, you need to give an incentive to investors, and the only thing that is not happening is that when the tariffs were announced at 19%, the peso was trading between 56 to around 57. With these corruption issues at these said levels, the peso is still at 57.75. So the market hasn't really adjusted, probably because we have a very good central bank that helps manage the volatility. But what we need as a country is to be able to sell it at a good price. Since we don't have that much infrastructure, we don't have that much resources, but we have a good opportunity in the Philippines for manufacturing. We have strong services. So we need to devalue the peso, or shall I say, slightly adjust the currency so that we become
Yeah.
competitive. And probably in my book, we're looking at probably closer to 58.50 to be a good level to be competitive to our peers. And this is the problem of the tariffs. Indonesia, Malaysia, Thailand all had 19%. These are manufacturing countries. The Philippines is not yet a manufacturing. So if they are going to remain competitive and sell their exports closer to 2024 levels, they'll have to depreciate their currency by roughly 9%. We've already seen India adjusting by 5%. So if these other countries feel that their exports aren't competitive with the Trump tariffs, then definitely a creeping depreciation will most likely materialize.
Okay.
So that I think is something that's lacking. So probably at 58.50, we could see the likes of tourism, uh, you know, flourishing
Yeah.
if the peso were a bit weaker. So there are other markets that would benefit on a weaker peso. Plus, it will help our spending thanks to the OFWs
Yeah.
because their value for money is much higher because their income is dollars.
Yeah, echoing the sentiments of HSBC economists right there, Jonas. Another thing I wanted to ask you, what's your advice to investors, to CEOs, C-suite executives, and retail investors as they navigate this junction, Jonas?
Okay. Well, I think at this point in time, given that we're expecting probably at least 25 basis point cut in the Philippines and probably the Fed, the fourth quarter to early first quarter could be a good opportunity to uh, issue debt. So this would be a proper time to probably look into the present situation and reassess their plans moving forward. So don't get discouraged with all of this global uncertainty. Sectors such as food, retail, and real estate are the key sectors to look into. And real estate takes time. So regardless of the weather, the geopolitics, they just have to press on
Yeah.
and take advantage of, uh, you just have to steady the course and, take advantage if interest rates were to go down. Probably fourth and first quarter is the time to look at borrowing opportunities. And for investors, take advantage of these uncertain times to probably position yourself, especially when the dividend yields at these levels are probably between 6 to 7.5%.
Right. Okay, one more thing before I let you go, Jonas. Wanted to get your reaction on a proposal by former Finance Secretary Cesar Purisima. This is with regard to corruption. He suggested the demonetization of 500 to 1,000 peso bills, lowering the highest circulating note to 200 pesos as a way to deter corruption, because it's gonna raise the cost and the logistical difficulty to move that money around, that dirty money around. Jonas, what are your thoughts on this?
Well, it will be a deterrence for this type of activities. However, we know that these people are, they find ways to be able to move money in other ways. So by lowering the denomination, that makes it difficult to probably keep this money in physical. So it might be difficult for just one room to put in 1 billion pesos. So they probably might have to buy a house. So again, it gives you a lot of ways to try to track these people in their purchases now that you have lower denomination. But again, this will also provide them to look into the likes of crypto, and we need to be able to ensure that we're able to track these digital currencies uh, more closely.
Yeah, if there's a will, there is a way. Jonas Ravelas, thank you so much for sharing your thoughts on all of this and more with us.
Thank you for having me, Mikey.